Michael Burry purchased his first credit default swaps on May 19, 2005 in preparation for the housing crisis. Dutch Bank has offered $60 million in credit default swaps, with $10 million in each of 6 distinct bonds. His forecast? The United States mortgage-backed securities, which was formerly a reliable and respected investment product, has gradually evolved into a false time bomb due to corruption and avarice. This wager was not a gamble in his opinion. He conducted the research, read the papers, and predicted the outcome. His issue was that the rest of the world wouldn't even begin looking for him for another 2 years. The S&P 500 didn't reach its peak of 1576 points until the 11th of October 2007. The S&P closed at barely 676 points on March 10, 2009, a 57% drop 1 year and a half later. From this one wager, Michael Burry generated a personal profit of $100 million while earning almost $700 million for his investors. But in the years preceding this incredible achievement, he was regularly criticized by the investment community and even his own investors. After all was said and done, he received criticism that ultimately caused him to close his fund. But why am I bringing this up to you right now? 15 years ago, this occurred. You probably guessed it. Right now, history is being repeated. But before we continue, make sure to keep yourself informed and engaged by subscribing to the channel, clicking the notification bell, and turning on all notifications so you won't miss our latest uploads. Burry was the first to see that there was a big problem with the rapidly expanding subprime mortgage sector. He reportedly said in an interview, quote, "I can see the credit standards within these pools deteriorating. I was extremely confident in the outcome. There are investors who made tens of millions off this and were still pretty upset." End quote. Michael Burry originally forewarned of significant inflation as a result of the Fed's massive money printing back in February of last year. He was criticizing the US government and the Federal Reserve for their trillion-dollar stimulus program while tweeting to get people ready for inflation and using the hashtag doomed to repeat. And he was the dissenter at this time. All appeared to be well at the moment. Although the Fed was producing money, inflation remained low. The most recent data available at the time indicated an annual inflation rate of just 1.7%, which is less than the Fed's target. He was simply early though, in typical Burry fashion. 12 months later, our current inflation rate of 8.6% is scorching. He even posted a month ago, quote, "Habitually be 1 to 2 years early on literally everything and you too can attain broken clock status," citing a tweet by Elon Musk in which he described Burry as a broken clock. But what's really intriguing is that for the past few weeks, Michael Burry hasn't simply been celebrating his successes. Instead, he's been extensively tweeting about why he thinks the current economic crisis and following market decline have only just begun. Please don't mistake this video for me being a major doomsday prophet on the channel, but I do want to at least provide Michael Burry's whole justification so that you can start to comprehend what he's thinking. He feels the worst is yet to come, and that is the main message. So much so that he believes the S&P 500 might drop another 50% from its current level. According to a tweet from Burry on May 3, quote, "Regarding paradigm shifts and speculative peaks, the S&P 500 bottomed 13% lower than 2002's bottom in 2009, 17% lower than 1998's LTCM crisis low in 2002, and 10% lower than the 1970s low in 1975. 15% lower than the COVID low is an S&P 500 value of 1862, roughly Shiller PE of 16, nominal PE of 9 in historic range." End quote. I won't lie, it took me many readings to fully grasp that phrase. We dropped to 1862 points when you consider that we are 15% below the 2020 S&P 500 low. That's absurd, since it implies that Michael Burry expects a peak-to-trough decline of 61.4%, which would return us to the historically average Shiller P of around 16. Michael Burry predicts that the stock market will decline by a minimum of 50% or more from where it is now. Considering that the market has recently had a 6.5% bounce, this daring prognosis has once again drawn criticism. Short-term bounces, however, does not necessarily indicate that things are in the clear, as we have witnessed even during the past few days. Michael Burry made a comment regarding this potential scenario. He recently tweeted, quote, "Dead cat bouncers are the most epic. 12 out of the top 20 Nasdaq one-day rallies happened during the 78% drop from the 2000's top. 9 of the top 20 S&P 500 one-day rallies happened during the 86% drop from the 1929 top." End quote. Even at the darkest periods, the statistics reveal that it's actually pretty usual to have robust short-term recoveries among the longer-term downward trend. Again, there are a lot of figures to wrap your brain around, but that's not what he's getting at here. Along the slope, 12 of the top 20 Nasdaq bounces took place. Along the slope, 9 of the top 20 S&P 500 bounces took place. On May 5th, he added, quote, "After 2000, the Nasdaq had 16 bear market rallies over 10%, averaging 22.7% before bottoming down 78%. After 1929, the Dow had 10 bear market rallies over 10%, averaging 22.8% before bottoming down 89%. End quote. Burry is sure that the issue we're facing now is just the beginning of something far bigger. In order to support his argument, he also mentioned the relatively modest trading volumes experienced so far during the 2022 downturn. According to him, quote, "Top to bottom, Microsoft traded 5.2 times shares outstanding by 2002, 3.3 times by 2009, and 0.5 times so far. Amazon traded 5.7 times by 2002, 6.6 times by 2009, and 0.9 times so far. JP Morgan traded 3 times by 2002, 5.9 times by 2009, and about 0.7 times so far, etc. Enough takes time." Therefore, even though the market has cooled off considerably in 2022, and everyone appears negative from what you hear, the selling hasn't even begun when you check out the trading volumes. Check out this graph. As you can see, market withdrawals haven't even truly begun yet. The markets are still receiving money. Burry believes that during the next 5 years, there will be a lot more selling activity, which will result in considerably higher stock market falls. He expressed his disinterest in having to deal with the situation. On the 24th of May, he tweeted, quote, "As I said about 2008, it's like watching a plane crash. It hurts, it's not fun, and I'm not smiling." End quote. And the interesting about Michael Burry is that he already witnessed all of this twice. First during the dot-com bubble and once in 2008. He has repeatedly observed these repeating human behavioral patterns. He has researched the excess and greed that led to the significant booms and collapses, and in my opinion, that's what gives him such assurance when he tweets or talks about these subjects. I found this chart, which he recently uploaded to Twitter, to be pretty eye-opening. We can see the 10-year run-up of the S&P 500 in white, the dot-com boom in yellow, and the Great Depression before it in green. Michael Burry remarks on this by saying, quote, "Third time's a charm. Gotta love human nature. Nothing if not consistent." End quote. He is aware of where this pattern of human behavior leads because he has witnessed it repeatedly. Only a year prior, he tweeted that he has just witnessed the biggest speculative bubble ever by 2 orders of magnitude in all of history. Maybe it's just reached its breaking point in his eyes right now. However, all of this is obviously just the stock market. We must keep in mind that the economy is, of course, the main justification for Burry's viewpoint. Now that we are aware of Burry's views on inflation and are aware that the Fed is raising interest rates to make it more difficult for businesses to borrow money, it is important to keep in mind that rising interest rates also have an impact on the main pillar of the economy, the consumer. Unfortunately, consumers have less money to spend in tough inflationary settings that result in significant interest rate increases since more of their savings and income are used to pay off loans. Because lower discretionary spending results in lower sales for the businesses in which we have investments, this frequently triggers a downward spiral. So, in a perfect world, you want the customer to be making money. Burry has, however, recently hinted that consumers aren't doing all that well at the moment, stating, quote, "US personal savings fell to 2013 levels. The savings rate to 2008 levels, while revolving credit card debt grew at a record-setting pace back to pre-COVID peak despite all those trillions of cash dropped in their laps. looming, a consumer recession, and more earnings trouble. End quote. Burry is plainly concerned about the shrinking of savings since it not only encourages people to use credit cards more frequently in an environment of rising interest rates, but also because it results in lower spending, which affects the bottom line of the companies in which we have investments. Amazon's first quarter numbers were one anecdotal piece of evidence that Burry recently mentioned. As quoted by CBNC, revenue at Amazon increased 7% during the first quarter, compared with 44% expansion in the year-ago period. It marks the slowest rate for any quarter since the dot-com bust in 2001 and the second straight period of single-digit growth. Burry responded by saying, quote, "And so Amazon says to GDP, there's your weakening customer," end quote. Burry then sent this tweet in response to that one that contrasts the US personal savings with the GDP. As you can see, savings are covering a less and smaller percentage of America's GDP at a time when it is declining. Therefore, according to Burry, the whole picture includes inflation, interest rate increases, a decline in consumer savings, and a consequent decrease in discretionary spending, all of which contribute to poorer firm profitability and the stock price re-ratings that have been observed so far. Burry believes that we are still only in the first inning. It's a very interesting issue to examine, and while I won't stick my hand up and claim to know exactly where we're heading next, I do ask that you kindly let me know what you think of Michael Burry's ideas. He is undoubtedly very pessimistic, but he probably is. Do you believe he is correct? Do you believe he is falling short? I'd be interested in hearing your opinions. Please leave a comment below, like the video if you enjoyed it, and subscribe if you want to see more. I always appreciate it. Thank you so much for watching. If you like this video, please remember to like, share, and subscribe. See you guys in the next one, and remember, keep living life bullish.